I'm Jeni Browne. Welcome to this week's MFB News. I hope you're all very, very well and you were able to get out and absolutely enjoy the incredible weather we had last weekend. And guess what, guys? Looks like we're forecast for some more next week too. Now, a little bit of a different MFB News for you this week. Because there's a lot going on with regards to the tensions with Israel, Iran and the US, because you will have seen reports talking about things like, for example, the Strait of Hormuz being closed off and the impact on oil prices and inflation. And I'm sure a lot of you are kind of scratching your heads and thinking, you know, beyond the fact this is obviously an incredibly worrying time, actually the impact this might have on your finances, particularly mortgage rates. And so because of this, and also because of just general kind of mixed messages that you'll be hearing in the media with regards to the expectation of interest rates going forwards, it felt like a really good time to have a catch up with David Whittaker, who is CEO of Keystone Property Finance, who is, and for those of you who've seen him speak before will know firsthand what an incredible kind of understanding he has of the capital markets, the sort of global financial system, and how this all filters down ultimately into what you are paying for your mortgages. So I called up with David on Tuesday morning. We agreed to have a conversation. David very kindly gave up his time. He's a really busy guy. And at this point there was kind of bombs being dropped and a lot of concern about what was going on. We agreed to speak at 7:30 this morning, Tuesday morning, by which point we woke up and it was announced there'd been a ceasefire. So I suppose the kind of first thing to say here is that it is an incredibly volatile period of time and things are changing minute by minute. What would you expect with Donald Trump leading the way? Nothing less than that, I'm sure. But actually, it really kind of made me think that at the moment there is a lot going on. Things can change literally on a dime. And so to really understand how this could impact you is really worth knowing. So here's what David had to say.
So David, thank you so much for joining us this morning. It's really bright and early, well, not so bright, but definitely early today. And we asked you to come and join us to have a chat with us about the situation in terms of US, Iran, and how this can impact mortgage rates. We agreed to speak on Monday, it's Tuesday morning, and overnight there's apparently been a ceasefire. So I'm sure you've got lots to say on the subject. So I'm just going to hand over to you.
And I guess, Jeni, by the time you've edited this and sent this out to your viewers, much could have changed yet again, because after all, this is the world of Donald J. Trump sitting in the White House and waking up and going on Truth Social and trying to run the world by a social media account. But listen, the good news is there would appear to be a ceasefire overnight, which Israel has now also announced and agreed. The representation of it by Iranian TV was somewhat less. America had backed off because they sent some missiles over Doha yesterday afternoon, but quite clearly the Iranians had signaled they were going to do it to the authorities. So whilst missiles were thrown up, it was exactly the same number of missiles as America dropped on Saturday night on the Iranian nuclear facilities. So this is gesture politics, but if that brings a ceasefire both in the short and medium term, it is to be welcomed. So how does that play out? Well, oil prices, which had already started to settle down, bearing in mind, and one thing that Trump did say that was actually credible, he has called this the 12-day war, which of course there was a 6-day war back in the 70s. So what he's trying to do, he's lining himself up, he thinks, for a Nobel Peace Prize for terminating the threat of a wider war across the Middle East region. But oil is already back down to $65 a barrel. You won't see it at the petrol pumps for the next couple of weeks because, of course, the petrol stations have been price gouging at your and my expense yet again. And obviously the stock markets in the Far East had a good night, or day for them, but a good night for us, with the Nikkei in Japan up over 1% and the Hang Seng in Hong Kong up 1.75%. So these are all good signs of an economic reset where people are feeling more positive about the state of the world. So you'd expect European markets and, of course, the London stock market, when it opens in about 30 minutes' time, you'd expect an improvement over here of about 1% as the news filters down through the markets. How will that play out for us? Well, yeah, somewhat is the answer. Listen, 5-year swap is down at 3.72%. It's been coming down gently over the last few days. So that reflects not only domestic view, but international view. I don't think there is a massive downside on interest rates in this country. I think, bizarrely, that the pressure, if anything, over the medium term, and I'd say that's anything beyond 6 months, because I think we've all learned not to look too far ahead, is upward only. We have inflation now built into the system. We will all have seen our council tax bills go up in April. Employers will have seen their national insurance bills go up, which ultimately manifests itself in the cost of products on the high street, because there is no magic money tree at the bottom of most businesses' gardens, although Rachel Reeves seems to think in her naive world that there is. And of course, we've now got the second round of public sector pay awards feeding through, either because they've already been agreed and they are significantly above inflation, or for whatever reason, areas of the public sector are holding out for bigger pay rises. The junior doctors, who I gather we now must call resident doctors, they got 25.2% last year, and they're asking for 29% this year, or they're threatening to go on strike yet again. That's a wonderful line of work to be in, isn't it? But all these things mean that inflation is not going to go back down to 2%. We missed the mark last month, or was it 3.4% again? And that's not necessarily a bad number, but the suggestion that base rates are going to go down fantastically is for the birds. I am the man glass half empty on interest rates. I went out last October and I said ending 2025 at 4% would be okay. 3.75% would feel nicer, when two institutional banks were saying 2.25%. And I stood up at one public gathering and said, whatever drugs they're on, could they send some my way? Because I'd like to have a recreational weekend. That is for the birds. There is no basis under which any economist, and for every economist you get a different opinion, there is no basis under which interest rates are going to go back to the rates that we saw for 10 or 15 years after the general financial crisis. So I think we need to manage our expectations. I think there is room for swap rates to come down a little bit, but your viewers will know that when a bank base rate moves down by 0.25%, which clearly it didn't last week, swap rates don't come down by 0.25%. A 5-year swap reflects a view over 5 years, whereas a base rate is a short-term thing that could move every 6 weeks. So I think whilst there is room for base rates to come down perhaps once or twice before the end of the year, hey, I'd like to see twice. It's in my interest as much as your viewers' interest. I think once is a bang on for November, and you might see swap rates coming down perhaps another 5 or 10 basis points. If they were to come down much more than that, then something really bad is happening. Whilst we might welcome it in the property industry, that would mean that the economy in the broader sense outside the property market is in deep, deep, deep trouble. And I don't think your viewers would welcome that either.
Definitely not. Thank you. So looping back to the situation with US, because I just want to touch briefly on, I suppose, almost illustrate the kind of exposure that the mortgage market has to things that go on in places that feel very, very far away. So yesterday, before we had this ceasefire signed, there was chat about the Strait of Hormuz being, I'm hoping I pronounced that correctly, closed off, and there were some concerns about oil prices, and that could then impact on ultimately UK mortgage rates. So I just wonder if you could kind of maybe give us some thoughts about the things that you're watching with the situation kind of evolving and unfolding, and how that could maybe play out for mortgage borrowers.
Well, the Straits of Hormuz are the bottleneck in the Arabian Gulf, which is 31 miles wide, and effectively the Iranians control it from one side, and the Omanis and Qataris from the other side. And it is the channel through which 21% of the world's oil currently travels to get out, principally, bizarrely, to the Far East and to China. So China would not have welcomed a cessation of oil supplies out through the Gulf of the Straits of Hormuz, because 50% of their oil comes from there. So you can well imagine that, the Chinese don't often make a lot of noise on international affairs. I suspect their telephone line from downtown Beijing to uptown Tehran, or whatever is left of it, was burning red hot, and they were saying, back off. So if that had pushed oil prices up, that would have pushed inflation up. And then again, that would have added to the pile of challenges that we have in this country over our inflation and thereby interest rates. And when successive governments of all stripes in this country have removed virtually all forms of financial control other than interest rates as a mechanism, you only have one blunt weapon. So inflation goes too high, you have to put up interest rates. The correlation between the two isn't as obvious as it used to be 10 to 15 years ago, because of course most of your viewers, and indeed you and I probably, are on fixed rate mortgages, and it's not just buy to let, it's homeowner mortgages, and many of us will opt for 5-year rates. So unless you're going to have to reset in a period of elevated interest rates, and people had to do that in late 22 and early 2023 until the beginning of this year largely, the pain is deferred. So as a weapon, it's actually a pretty blunt-edged instrument, because all it affects is things like bank overdrafts, and that impacts small businesses. So it's a remarkably crude weapon, and it's not a weapon that actually other than the messaging it sends, it doesn't actually solve the problem any longer.
Yeah, perfect. Thank you. I know you've got a really busy few days, David, so I really appreciate you taking a bit of time to come and explain to everybody what's going on and maybe what the future is looking like, at least for the next 6 months to a year at least. Really appreciate it. Have a lovely day.
And you too. Let's hope it all settles down. And no one wants international conflict, and we've had too much of it in the last few years.
Absolutely. Cheers, David.
Thank you, Jenny. Bye.
Thanks, bye.
So there you go, another interesting conversation with David. Always got really, really useful insight into what's going on, and we always really welcome his views. So a slightly different one from us this week. New normal service will be back next week, and I'm sure we'll have more to talk about then. Until that time, if you have any questions, do give us a call, 0345 345 6788. And as always, there's loads of information on our website. You can also chat with us online. If you do that, you're not going through to a robot, you're going through to a person. You might be really unlucky and actually get through to me. And we'd love to hear from you. Have a really fantastic week. Let's hope for a more peaceful 7 days ahead of us, and we'll see you next time.